Hello, in this video we'll continue of our alimony problem set. This is problem number 4. If you have not yet looked at problems 1 through 3, please do them because these problems are meant to be viewed in order. Lemon and Lime were married for many years. On January 1st, year 1, they were divorced. They have a 12-year-old son, Limonero, who has since been, on that date, January 1st, year 1, living with Lemon in the custody of Lemon. During year 1, Lime had gross income of $150,000 and made timely payments under the divorce decree. Under the terms of the divorce decree, Lime is to pay Lemon $70,000 in year 1, $20,000 in year 2, and $0 in later years. These payments cease on Lemon's death or remarriage. Now assume the following. Lemon and Lime are not members of the same household. The decree does not specify any specific tax consequences, and the decree is issued before 2018 and there have been no modification. So remember, whenever we have any type of income tax issue, we always start by asking our 5 questions. The first question is, what amount of gross income, if any? This deals with inflows. And looking at our fact pattern, Lemon is receiving $70,000 in year 1, $20,000 in year 2, and 0 in later years. So we have to ask if there's any potential income that needs to be included with respect to Lemon. Next is what amount of deduction or credit. And this deals with outflows. Here, Lime is making these payments to Lemon. So we have to wonder about that. The next question deals with when. If there's any tax consequences from the amount of income, deduction, credit, when is that, or are those items, respectively, do they have to be reported on the tax returns? What year? Next is who. Who has to report those items? We're dealing with Lemon and Lime, but we also have Limonero as another party. Now, I'll just go ahead and tell you that Limonero is a son, and when we deal with dissolution of marriage issues, that son has no respective issues with respect to this. It's Lemon and Lime, the 2 spouses. Finally, what's the character of the respective items? Character is something you're going to be worried about in future videos. We're not going to worry about that here, so do not worry about character. But I'll go ahead and tell you, if you're wondering, the character is going to be ordinary with respect to these items. We're dealing with dissolution of marriage, tax consequences of dissolution of marriage. And if you remember in our previous videos, we talked about really 3 different classifications of activities when it comes to dissolution of marriage. The 3 items are division of property, alimony, and in between the 2, property settlement. Now, the reason they're on a continuum like this is because division of property, that's where, again, the spouses come to the marriage with certain property, and then the decree will split that property. There's no tax consequences. And we don't have that here. We're not saying that, okay, Lemon brings this money, or this property, Lime brings this money, this property. That's not an issue here. So this cannot be a division of property. Alimony deals with support. Support from one spouse to another. Again, the idea that when you go through marriage and you go through that contract and you agree to support the other spouse through death, sickness, health, whatever it is, I'm sorry, not death, through death, through, sickness, health, but upon death it ends, or remarriage it ends. That's the idea of alimony. That, and usually in our society, in our law, we view as, okay, the spouse that has more income, makes more money, is, there's a duty, or there is a legal obligation to have to support the other spouse. That's where alimony is. Property settlement comes from, and the reason it's in the middle is it's a view of both ideas. It has that alimony aspect where it comes from the obligation of the marriage, from that contractual. It's not from property that came before the marriage. It comes from the whole idea of the marriage, that contract. But unlike alimony, where it ends upon a certain time, property settlement does not end. It's simply just, okay, well, you get that amount. And that's the idea there. So really the next step is to look whether it is alimony, because under the tax law, there's 5 ways that we classify whether something is alimony versus property settlement. Now, it's important to understand that when you have alimony, there's the old tax law and the new tax law. The new tax law comes after the Tax Cuts and Jobs Act of 2017, and what that says is that any separation or divorce agreements after 2019. After 2019, they are going to have the new classification of alimony where it's the same treatment as property settlement where there's no tax consequences. No tax consequences. So that's how the new tax law, or that's what the new classification of alimony. Also, if there is a divorce or separation agreement prior to 2019 that takes place, but there is a modification after 2018, then and it's specified in the agreement that the parties want the new alimony rules to apply, then it will be new. However, we're told here that this decree is issued before 2018, and there have been no modifications at all. So we're applying the old rules. And with the old rules of alimony, the payee spouse that receives alimony has to include in gross income the amount of alimony. The payor spouse gets a deduction for the mirror image amount, and it's an above-the-line deduction, which is very good type of deduction to have. Now, child support is not considered alimony. It's similar to property settlement with no tax consequences to either party. But we don't really have any tax child support issues here. There's nothing even stated about, okay, well, this is contingent on child or it is child support, so we don't have to worry about child support here, just so you know. But if you did have a child support issue, which is discussed in the previous problems, then you would have to consider that. That's very important to understand. So to make sure that we have alimony, and again, to distinguish property settlement versus alimony here, we go through our 5 requirements for alimony. So the first is that it has to be a cash payment, which we have here. The payment in year 1 is $70,000, payment in year 2 is $20,000, and then year 3 in the future is 0. So we have cash. The next is that this comes from a divorce or a separation agreement. Divorce or separation agreement. And the tax law, under Code Section 71, has some definitions for that, and it specifically states that one of the ways you can get that is that if there's a divorce decree, which is what we have here, in terms of the divorce decree, right, under the terms of the divorce decree, lime is to pay lemon. So there is a divorce decree where there is a order by the court that one spouse is to pay another. So we do have that criteria met. The next is that in no way does it say it's not meant to be alimony. So the agreement does not say not alimony. And there's nothing here that specifies that. And it even says the decree says nothing about the tax consequences. So that even goes further to say that this is met. It does not say it's not alimony. Next, number 4, is that the members, the payor and payee, cannot be members of the same household. Not members, same household. And specifically, it's at the date of payment. And that's what we have here. They're not members of the same household, but specifically we look at the date of payment, just so you know. Finally, the last requirement is that the payment ends on death of the payee spouse. And I would even go further and add to that, or remarriage, because that's the idea of alimony again. And we're told that these payments cease on lemon, the payee, right? Because lemon is the payee, lime is the payor. They cease on lemon's death or remarriage. So we have all 5 criteria are met. Boom, we have alimony. We do have alimony, and it's under the old rules. So that means that the payee and payor spouse, payee, which is lemon, is going to have to include in gross income. Payor is going to get to deduct. So you might be thinking, okay, well, in year 1, that means that lemon includes $70,000 in gross income. In year 2, lemon includes $20,000 in gross income. And then year 3 and in the future, lemon includes nothing. And then lime gets a corresponding deduction for those same amounts. Year 1, lime gets to deduct $70,000. And then in year 2, lime gets to deduct $20,000 because, again, that's alimony. So that's what you're thinking, right? And you would be right under the general rules of what we've seen so far. However, there's a special rule, and this is under code section 71F. It's a special rule that's known as the excess front loading limitation. And basically the idea here is that if you look at the first 3 years from the date of divorce, so January 1st, year 1, so this is year 1, year 2, and year 3. And if the payments in year 1 and year 2 are significantly more or substantially more, they substantially exceed the payments in year 3 or later years, then you have to apply a special test. And that's what we have here. In year 1, we have $70,000. In year 2, $20,000. In year 3, 0. And you might be wondering, why might a spouse want to do this? Well, from the payor standpoint, from Lime's standpoint, the idea is that with deductions, you want to accelerate. You want to accelerate deductions. Why? Time value of money. If you're able to deduct $70,000 in year 1, rather than deduct $10,000 in year 1 and $10,000 over the next 10 years, let's say, you'd rather take the $70,000 in year 1 because a deduction today gives you tax savings, which that tax savings is dollars that you bring back today, and a dollar today is worth more than a dollar 10 years from now. That's the idea. Whenever you're dealing with deductions, the party that gets a deduction prefers to have a deduction immediately. They want to accelerate deductions. Versus income inclusion, is the opposite. You want to defer, because if you can save $1 in taxes today, that's $1, and you pay that $1 in the future. Well, $1 that you save today is worth more than saving $1, later in the future, because it's time value of money again. So that's the idea here. Why sometimes parties why they would do this. Okay, and this is negotiating or whatnot. And the idea here also is that this looks too much like property settlement. Property settlement can be in the form of cash. Now, we go through all 5 criteria, and we are under alimony, but it just looks too much like property settlement. Because property settlement, the idea there is, upon divorce, there's usually some big payout. Like we have here, $70,000 in cash. Yeah, there's $20,000 in year 2, but that's an issue. So if you ever see alimony where it meets all 5 criteria, and there's a big payment in year 1, but there's $0 in year 2, year 3, that's going to be automatically subject to the limitations we're about to talk about, the excess front-loading limitations. But if you do have payments in year 1, 2, and 3, you do have to apply these tests, because it's possible you can have payments in year 1, and then a little bit less in year 2, but then it goes up in year 3, and then if you look at the total, it's fine. But here, you're going to see that there is going to be a limitation, and I'll show you why. So now what we're going to do is we're going to go through a 12-step process. We're going to go through a 12-step process, and this actually follows the language in the actual Internal Revenue Code. And you're going to be like, wow, this is really confusing. And I will tell you, though, that this is why when you're in practice, you do have books, you do have whatnot. But I just want to show you how this works and what kind of limitations are in place because of this. Keep in mind, again, that, and we'll come back to this, that Lemon would have to include $70,000 in year 1 and $20,000 in year 2 under the general rule. And Lime will be able to deduct those amounts under the general rule. But we'll see what happens to that later after we go through these 12 steps. Now that we know that alimony applies in years 1 and year 2 and in the future years, and again, we talked about the excess front-loading issue, where, okay, well, year 1, there's $70,000, year 2, $20,000, and year 3, and the future, 0. And that's a substantial difference in the beginning versus later. We have to apply in the actual code, a mathematical formula where we determine whether any portion needs to be what's called recaptured. So this is called alimony recapture. And the idea, again, is that it might be too good to be true to have the payor spouse get a deduction by front loading and get to accelerate this. And again, it takes more of a form of property settlement rather than alimony. So that's really what the key is here. So you're going to see there's 12 different steps. When you get to step 4, you have your second year adjustment, which is recapture in year 3. And then when you get to year 12, when you get to step 12, you have your first year adjustment, which is recapture in year 3. Just remember the inclusion deduction amounts that we calculated before under the general rule. Lemon has to include 70,000 in year 1 and include 20,000 in year 2. Lime gets a deduction of 70,000 year 1, 20,000 year 2. That's applying our normal alimony rules before we talk about the recapture situation. And what you're going to see is that if we do have recapture situation, it's going to be in year 3. Year 3 is when it comes into play for both of these items. So that's important to understand because we do look at the first 2 years when we do this analysis. And we also look at the third year as well to see what it is going in the future. So let's go ahead and start. So the first thing, or the first step, we'll call these steps, is to look at the alimony in the second post-separation year. So alimony in the second post-separation year, it's $20,000. So we go ahead and put $20,000 right here. Again, that comes from here, $20,000 in year 2. And then the second item is alimony in the third post-separation year. So the third post-separation year is 0 because year 1 is 70, 20,000 year 2, and then 0 in later years. So year 3 is 0. Then we add $15,000 to number 2, which is 0. So 15,000 plus 0 is 15,000. And by the way, again, this is from the code. So this mathematical calculation with the 15,000, that comes from the actual code section. And then again, this was based on, okay, well, wealthy spouses that are in a higher tax bracket, they potentially get a higher benefit. Okay, so the next thing is we take number 1, 20,000, minus number 3, 15,000, which is 5,000. So 5,000 is the adjustment for year 3 from year 2. Now, we're not just going to simply put that in year 3 because we got to worry about the first year adjustment. So we're saying of that $20,000 amount in year 2, 5,000 is going to get recaptured in year 3. And you'll see exactly how the recapture works. Okay, so now we go over number 5. Number 5 is alimony in the first post-separation year. That's 70,000 because, again, we've already classified as alimony. So 70,000 in year 1. Number 6, enter number 1. So number 1 is 20,000. So we put that over here. Number 7, enter number 4. So we go and put number 4, which is 5,000. Number 8, subtract number 6 minus number 7. So number 6 is 20,000 minus number 7, which is 5,000, is 15,000. Number 9, enter number 2. Number 2 is 0. Number 10, average of 8 and 9. So we're going to average these two together. 15,000 plus 0 is 15,000. Divide by 2, since the average of 2 is 7,500. Number 11, add 15,000 to number 10. So 7,500 plus 15,000 is 22,500. And then finally, number 12 is subtract number 5 minus number 11. That should be number 11. So number 5 is 70,000 minus number 11 is 22,500. And that gives us 47,500 is recaptured in year 3 from year 1. So we're saying of the 70,000 that was included in year 1 by Lemon and deducted by Lime in year 1, 47,500 has to be recaptured. Okay, so again, this is still the case. The general rule still applies for year 1 and year 2, but year 3 changes. So if we did have some amounts in year 3, it would change because these recapture amounts will get recaptured in year 3. So recapture is basically a negative of what the normal rule is, only in year 3. So that means that for Lemon, we're going to add these two numbers together. 5,000 plus 47,500 is 52,500. Lemon is going to get a negative inclusion, which is a deduction of $52,500, which is an above-the-line deduction of ordinary income. 52,500, 52,500, okay? Lime has to include that amount, and it's a negative deduction. A negative 52,500 deduction is a positive inclusion. So Lime, in year 3, has to include $52,500. Lime still gets the $70,000 and $20,000 deductions in year 1 and year 2, but Lime has to include $52,500. Lemon in year 3 gets a deduction of $52,500. And that's the end result. So in year 1, Lemon has to include in gross income $70,000. In year 2 has to include $20,000. In year 3 gets a deduction of $52,500. Lime gets a deduction in year 1 of $70,000, year 2 $20,000, and year 3 has to include $52,500 as ordinary income. So I hope this helps you understand. Obviously, these 12 steps, you're not meant to memorize. So if you do have, you're taking an exam, even the CPA exam or whatever it is, it's very unlikely you're going to have to go through all these steps. This is more of something where it's an open book exam you go through and deal with. The idea, though, to understand is, though, when you have payments like this, where you have a huge payment up front, even in year 2, but then years 3 in the future, if that happens, and it meets the characteristics of alimony, you have to do this, what we call alimony recapture. Alimony recapture, where in year 3, what happens is the payor has to include and the payee gets a deduction. So I hope this helps you understand this issue and how alimony recapture plays a role with respect to the tax consequences of dissolution of marriage.